Hey everyone, me Kevin here. It is time for your daily dose of FUD. Let's get right into your daily dose of FUD, which includes updates from not only the Federal Reserve, but also multiple earnings reports, the Philly Fed survey. We're going to break this one down. We'll talk about what the heck is going on with BTC and what happened with some interesting earnings yesterday. Let's get right into it. First, let's talk about what the most hawkish member of the Federal Reserve, Mr. James Bullard, had to say. Mr. James Bullard said that bringing inflation down to 2% may ultimately require the Federal Reserve overshooting interest rates well above 2%. This is kind of like the opposite of the flexible average inflation targeting that the Federal Reserve used to tell us about how transitory inflation would be last year, when they said, hey, we don't mind the fate of just letting inflation run hot for a little bit because it'll just average 2% in the long run. Well, James Bullard doesn't think so. He says, quote, if you want to put downward pressure on inflation, you'd actually have to get to neutral and then go beyond neutral. This was at an event hosted by Columbia University today in New York. And he says, quote, I think that's a major concern of mine. We're not really in a position to do that right now, but we have to get in a position to do that. So in other words, he's kind of saying like, the economy's not ready to support us being at 2% rates because it might be too restrictive. But we're in this position where we kind of have to because inflation is so high. Now, much of the Federal Reserve and many individuals believe that at some point, once supply chains improve, things will just get better. But he argues that he does not see inflation dissipating anytime soon. In fact, he says, quote, we have to manage the risk that inflation does not dissipate, as some people might hope. And after all, he says, the market is, quote, losing faith to some degree that inflation is going to dissipate in any amount of reasonable time. Now, there are two things really driving inflation. Obviously, the big one, supply chains leading to substantially higher input costs for corporations. But it's not just supply chains and even commodity costs, which are through the freaking roof for raw material costs. It's also the fact that wages are going up substantially, especially amongst those earning less than $100,000. We're seeing substantial wage increases to the point where even Apple just last week announced a pretty rare across-the-board wage hike for all of the employees, not in their engineering departments or their higher-paid tech departments, but in their retail stores where the Genius Bar workers are and the sales associates work. And so this is potentially creating, and we're not confident yet that it has, but it's potentially leading to fears that we will face a wage price spiral. Wage price spiral, wages go up, that leads costs for businesses to go up. Businesses want to preserve margins, so they raise prices, but then because prices are higher, wage earners again demand more wages, and you keep moving, so on and so forth. So far, the only person that I've really seen who's like in the whole economic space, and I'm sure there are many more out there, but one who's relatively prominent is the director of the University of Michigan Consumer Confidence Index. My goodness. This is that report that we got that showed that consumer confidence had actually fallen, that individuals were becoming less confident, and that they actually expected inflation to be lower in about a year's time frame, right? Which is good signs because it's like, oh, great. Maybe if consumers chill out and they stop spending as much, maybe inflation will go away. But the problem is, the director literally of that survey told us, yeah, we're seeing a decoupling of inflationary concerns from just supply chains, and instead we're seeing them move over to the wage price spiral side, which means even as supply chains get better, we might not actually see inflation come down, which I thought to myself, like, wow, that's weird, like, why? And then it hit me, oh my gosh. What did AutoNation tell us this morning? Now, I don't think AutoNation is going to be like every corporation in the world, but AutoNation is the largest car dealership chain. And to me, I don't know about you, okay, but to me, this just sounds pretty much like straight up corporate greed. But again, I want to hear it from you. They say discounts at car dealerships may be a thing of the past. Which, I mean, initially you hear that and I'm like, okay, yeah, JCPenney tried the whole no coupon thing and everyday low prices, and we saw what happened with JCPenney. Anyway, according to Bloomberg, AutoNation suggests that tighter inventories have persisted even as vehicle production has ramped up, and now argues that there's no reason to return to excessively high inventory levels on lots ever, because all that does is end up depressing new vehicle margins. And they also suggest that significant discounting ends up damaging their brands. And so now they're trying to do everything to keep their prices high. Get this, folks, and this is just nasty, ugly, and disgusting. GM and Ford are thinking about purposefully limiting production, even as chip shortages ease, so that way they can continue to maintain higher prices. Car dealers are also, more often than they have ever before in the past, are charging above sticker price. I'll give you statistics after this anecdote. Went to a car dealership, went to a Toyota dealership, and you see a normal Prius that usually retails for about $35,000 on sticker, had a byline under it that said $10,000 dealer premium. Basically, because the dealer has so few cars, they're just like, we're just going to charge an extra $10,000 because we can. Now, Jim Farley, the CEO of Ford, said that at Ford, this was only common in about 10% of dealers and suggested that this was unacceptable, but acknowledged it was happening. But when we actually look at the data, we see that in 2021, 2% of cars sold above their sticker price. So 2% of all cars sold above their sticker price. Last month, though, in January, for all the people in the inflation is transitory camp, 80% of cars, 80, that's 40 times as many, were sold above sticker. That's absolutely insane. But anyway, so look, you've got Bullard obviously sending up this massive fear flag in addition to what's happening in Russia, which we'll talk about in just a moment. And then, of course, you have Doves who say things like, no, we're not going to do emergency hikes. We're not going to go aggressive here because that could shock markets. And when I say shock markets, they're generally not worried about stock prices trending down. That actually de-risks things. They're worried about sudden circuit breaker style drops where all of a sudden banks are like, okay, stop lending, right? When you freak out banks, you stall lending, you cancel mortgages, you shock the workings of the economy, and that can lead you to a depression. He says, nah, that won't be a problem. We need to regain credibility. Let's get to 1% interest by July 1st. He moved that back, by the way. He first said June 1st, like a week ago, and now he's saying July 1st, but whatever. Let's get to 1% as soon as possible. Get back the credibility we need because right now we don't have any credibility left, is what Mr. Bullard says. Either way, look, the minutes yesterday from the Federal Reserve, they didn't give us any extremely hawkish clues, but we're starting, I mean, nothing more than what we heard in December, so it was like no news yesterday, right? But we're certainly seeing this massive divergence between people like Bullard, who are like, stocks will be fine, don't worry about it, markets will be fine, let's just hike. Of course, he's got to say that to sell his pitch, right? To sell his argument. And Mary Daly's like, no, we gotta be careful. We don't want to go into a depression by tightening too soon. Besides, inflation is transitory. And so you really got to evaluate yourself what the heck you're going to do with your portfolio, right? Obviously, you have two choices. You could just keep buying the freaking dip, which I bought a little bit of the dip this morning, and I feel responsible for crashing the market. But I don't feel responsible for calling the wedge breakout that we saw on gold when I bought over 7 figures of gold just a week ago, and now we're seeing that wedge breakout. The gold miners are doing better than gold itself, but look at like Barrick Gold, for example. They are absolutely killing it. And we're just now getting an update here that Russian forces are moving closer to Ukraine's border, say UK sources and The Guardian. It's not good, which we're going to talk about Russia in just a moment, but quick mention, then we're going to talk about Russia, then we're going to talk about the Philly Fed, that this video is brought to you by Titan. And of course, if you want any of my buy-sell alerts, check out both the links for Titan and my programs on building your wealth in the link down below. But let's listen to a sponsorship message from Titan. It takes a lot of time to keep up with everything in the stock market, and sometimes, quite frankly, you even lose sleep over it. I spend hours a day researching everything, and it's quite stressful. And quite frankly, this is where Titan can make your life a whole lot easier and less stressful. Titan is the first investment platform for everyday investors that want their money managed actively by a team of experts that do the research for you, so you don't have to spend hours reading articles or reading Federal Reserve reports or anxiously losing sleep over what Jerome Powell's going to do next. Having someone else manage your portfolio can save a lot of time. They even offer an actively managed crypto portfolio. So if you don't understand crypto but want exposure, you can have Titan's team handle it for you. You'll even see exactly how your money is managed through video, audio, and written updates on their mobile app. Right now, if you use my URL linked down below or go to titan.com/Kevin, you'll get your first 3 months of investment management totally for free. Join the smart way to invest with Titan. All it takes is $100 to get started. That's right, just for $100, that is depositing $100 with Titan, your first $100 of managed money with Titan, you can get started. Just go to titan.com/Kevin. Well, folks, now we need to talk about Russia. Blinken, and this is probably what's really weighing on markets today. Secretary of State Blinken is set to meet with Russian counterpart Sergei Lavrov next week as Biden warns that the possibility of an invasion is very high. We were initially told that Russia was going to start withdrawing troops from the border around Ukraine as some exercises had completed, but this was really just Putin saying, all right, to his foreign ministers. And it's not actually what happened. It actually looked like troops were sending more blood supplies to the border, that potentially as many as 7,000 more troops were moved to the border. And now Reuters is reporting and posting images of apparently shells that have hit buildings in Ukraine, including a kindergarten. Thankfully, it didn't appear that anyone was hurt. Monitoring agencies, though, in Eastern Europe have cited numerous ceasefire violations on both sides, and this is raising concerns that essentially this could be the perfect setup for false flag operations that Russia then uses to invade. Big problem. And the market's probably heavily reacting to this. Now, next we got to talk about the Philly Fed and what happened this morning with the Philly Fed. But it's also worth just quickly noting that treasuries are declining right now. We got the 10-year at about 1.97. This is actually helping steepen the yield curve, which is usually a sign that a recession is less likely to come. But this could be thrown off kilter because people are also fleeing stocks to the safety of bonds. And when you flee to the safety of bonds, you can screw up the yield curve. So the yield curve has been just a disaster. On one side, you got the Federal Reserve and its ridiculousness and the way they manipulate markets. And then, of course, now you have this fear play going on as well. So Treasuries going down to some degree makes sense. What we're seeing with the yield curves to some degree makes sense. It doesn't quite make sense that as fears are rising about an invasion, you're actually seeing oil go down 2%. But I'm just going to say for these two things, whatever. Like sometimes you just don't have an answer as to why the market does things. I will say though, we do have a little bit of a conversation to have about Bitcoin, and then we got to talk about the Philly Fed, because the Philly Fed, this was interesting from this morning, and then we're going to get to some earnings. Okay, so first of all, Bitcoin, of course, we're going to jump over to FTX, which if you have not yet signed up for FTX to get your free $10, make sure to do that. But we did have BTC break below our 2K support, which is not ideal. We want to see BTC above 2K. Honestly, Bitcoin has been doing quite well relative to stocks. The last, honestly, 6 weeks here, BTC has been performing much better, that is losing less money than a lot of different stocks. So it's quite interesting. And of course, you could cherry pick other stocks that have done well, but broadly, BTC has performed quite well here. So if you want to trade BTC or any of the other cryptos, make sure to check out FTX via the link in the description down below. Now, let's talk about the Philly Fed. Okay, this is a big one here, all right? So the Philly Fed released a report on manufacturing business outlook this morning. It was quite interesting, some of the commentary that we had here. So here we go. The survey's current indicators for general activity, new orders and shipments declined from last month. So this is generally, we don't want to see a slowing, right? Because that creates stagflationary fears. And so we're seeing some decline from last month's readings, but still positive. Now that's very important. We want to remain positive. And here is one of the most important sections. Firms continue to report increases in prices for inputs and their own goods. It's not just the input costs, it's that they're raising prices as well. The prices paid diffusion index edged down a little bit, so we didn't have as aggressive of an inflationary pressure, which could be a teeny tiny little sign of maybe a little bit of an inflection point there in inflation, which is good. I like seeing a little 3-point move from about 72 to 69.3. But folks, listen to this. 74% of firms, so like 3/4 of firms, reported increases in input prices, and only 5% reported declines. Now what we want to see is that number grow. We want to see, to verify this as an inflection point, we want to start seeing that maybe 65% of firms reported increases in input prices and 15% noted decreases, right? These are the things that we want to track. So this actually has a little inkling of good news. Now, this good news is certainly not enough to move markets, and probably very few people are actually paying attention to it, but it's very, very, very important. Now, this was interesting. Firms expect own price increases to match inflation rates. So in other words, we're expecting prices to kind of continue to spiral up, unfortunately. And this was not so great. Remember what we talked about regarding the wage price spiral? Firms expect their employee compensation costs to rise 5% over the next 4 quarters. That is not we're done raising employee costs or seeing employee costs go up. No. We still expect them to go up 5%. That is actually an increase from the last read that we had from November. Now, we also have the expectation by firms that inflation will be around 5% over the next year. This is a lot higher of an expectation by firms compared to consumers. Consumers think inflation is going to be like 3.5% in a year from now. So firms definitely expecting more inflation here. Now, then we also saw 38% of firms expect growth over the next 6 months. So you've got, almost 4/10, almost 40% of firms here thinking, oh, we're going to see growth over the next 6 months. But look at this. 10% think there'll be a decrease, and 45% think things will just be mostly stable. So this will be something to kind of keep an eye on as well. Is it possible that we start seeing growth in the number of firms that think we might expect a decline or flattening versus continued growth? So this is from the Philly Fed. Now we got to talk about some of the other earnings, but because there's some drama here, okay? Applied Materials sees supply chain challenges remaining throughout the year, but that's particularly because Applied Materials is already sold out for the entire year. Like, they literally are sold out for the entire year, which is mind-blowing. NVDA absolutely crushed it. Their margins fell slightly, but they did have a nice beat, and their Q1 guide came in at 8.1 bill versus the 7.3 expected. So really, really good here. They did take a $1.36 billion write-off on a prepayment for the ARM deal, so there was a little bit of a hit to bottom line here, but otherwise, absolutely killed it. Now, they didn't talk much about pricing pressures or about supply chain issues. They briefly mentioned supply chain issues as essentially things that they're still working on and that they work with regularly, but not a lot of insight here. Biggest insight I would say from them is that they noticed that a substantial decline or significant weakness in crypto mining demand. That was the wording that they used. Now, I also want to show you an example here of what Advanced Auto Parts said. I thought this was interesting because I've been reading a lot of these reports. I don't even want to get into Wingstop. Okay, Wingstop had their chicken prices skyrocket to the tune of over 29%. Their total costs were up like 17%. They're like, oh my gosh, we got to raise prices. But you're seeing this kind of madness at almost all of the earnings calls. I mean, it could be O'Reilly Auto Parts, Heineken, Kraft Heinz. These are just some from the last few days. I mean, of course, I've been reading Under Armour, Ralph Lauren, I mean, you name it, Crocs, Shopify. They're all complaining about the same things. But I want to look at Advanced Auto Parts because this I thought was very, very interesting. They said here at the top section, so let me provide color on what we're thinking about our pricing strategy. 3 things. First of all, we've been conducting a survey among our professional customers for many years. And to give you a data point from last year's survey, the top 3 variables, so the top 3 reasons somebody would buy stuff from Advanced Auto Parts, were number 1, ease of doing business. Number 1 was availability. Number 2 was ease of doing business right here. And number 3 was speed. So do you have the part? How fast can I get it? And how easy is it to work with you? Right? In the particular order that I initially read it here. And they said that all of these 3 factors were more important than price. That's wild. Because that means the professionals are like, I don't care, give me the part. My customer will pay. Don't care if the price is higher. They got more dollar hollers. Let's go. Give me the parts. So this was quite interesting. I also saw on the Crocs earnings call that they're trying to do NFTs with Crocs, and I'm like, the last thing I need is more Crocs around. Anyway, I do briefly want to talk about Matterport, Affirm, Palantir. Look, if companies have no earnings, which these companies don't, you're just going to probably keep seeing pain. I hate to say it. It was one of the reasons I sold a while ago. Because you are just in, unfortunately, a regime change, a cyclical change. And this cyclical change will continue unless we hit like a soft landing. And it's like, oh, okay, wow, inflation actually came down, and then maybe we can get more into the companies that have no earnings yet. But otherwise, there's no floor right now. I hate to say it, there's no freaking floor. It sucks. Now, obviously, if you want to join me in the morning course member live streams where I talk in more detail and I answer your questions and respond to exactly what you're looking for, make sure to check out the programs on building your wealth down below. A lot of new content is being added to these, especially the wealth course. I mean, there are probably going to be about 300 lectures coming out on that course. It's going to be amazing. It's still in development. You check out, but that one's still in development. If you want something a little bit more complete, the real estate investing or the stocks and psychology of money group, do check those out. But I want to say about Matterport as well. The fact that they're coming out with a $59 Axis is great to be competitive, but is honestly kind of terrible for their margins. I mean, back in 2017, when I originally wanted to invest in this company, they were selling their Matterport Pro 2 for like $4,000. Now they're selling a $59 motor that you throw on a tripod so that your camera can spin around. Your iPhone LiDAR-based camera can basically do the work for you. Now, if you want to sign up for this, by the way, you can put your email address in here and sign up for it. I don't get anything from this. It's not sponsored. This video is brought to you by Titan. But I do encourage checking this out. I mean, $59, their product revenues, I think, are going to go negative. Well, they are already going negative. I mean, like, their margins are going to go negative on product. Which is not good. They're in this transition. And I think this is a very difficult thing for folks to remember as well, because this is the same thing I said about Coinbase, is that when a company's in transition, you're gonna go through like an SH9T period of time, okay? Because what happens is, if you have high product revenue, or in the case of Coinbase, their product would be, let's say, trading. So we'll put PT, okay? If you have high product or trading revenue, in the case of Matterport and Coinbase, but you know that this product revenue is going to decline at the same time as your service revenue goes up, this period of time right here is gonna suck for the stock. And we've seen that at Coinbase, and I do expect that for Matterport. And then AFRM, unfortunately, if the odds of a recession go up, the last thing you want is to be here. Now, I love AFRM. Don't get me wrong, I love AFRM. But I said that originally when I first bought the company. I'm like, this is great as long as we're in a bull market and people keep borrowing crap and spending. But, they hold 41% of the debt that they issue. Those are bags, man. People stop paying those are bags. Anyway, hopefully we find a bottom soon, but we certainly haven't found them yet. But I'm watching every single day. All right, my friends. Thank you so much for watching this. Please check out Titan via the link down below. Please check out FTX. And, of course, check out my programs on building your wealth. Thank you very much, and we'll see you the next time in the next video. Goodbye.